Ladies and gentlemen, I want to start with a question that I think is eating at every gold and silver investor right now. You bought gold, you watched the geopolitical chaos, you followed the playbook, you did everything right, and your gold stack, your gold ETF, your silver position is red. Down 13, down 14%, down more than 46% in silver from its January high. And bombs are still falling in the Middle East, and central banks still buying gold at double the historical average, and the national debt just blew past 39 trillion. So I want to ask you directly, do you understand why that's happening? Not the surface explanation, the actual mechanism. Because if you don't, you're going to make the wrong decision at exactly the wrong moment. And that decision is going to cost you the most important trade of the next 5 years. I have been studying how gold and silver move during geopolitical crisis for over 40 years. And what I am going to show you today is not an opinion, and it is a mechanical sequence that is repeated after every major oil shock since 1973, without exception, every single time. And once you see it clearly, you cannot unsee it. And once you see what always comes next, the part that almost nobody is talking about right now, you will understand why I am using the word unthinkable. By the end of this, you will understand the exact mechanism that drops gold during a war. The historical record of what gold and silver do after that drop, going back 50 years. The four-phase recovery pattern I have watched play out after every major oil shock in my career. And why the structural setup in 2026 is more extreme than anything I have seen in any previous cycle. Which means what comes next will be larger than anything we have seen before. Subscribe now. Let me start with the mechanism, because until you understand this, nothing else makes sense here. Here's a question most financial media refuses to answer clearly. Why does gold fall during a war? It seems completely backwards. Gold is supposed to be the safe haven, the financial bomb shelter, the thing you buy when the world is on fire. So why, when Iran closed the Strait of Hormuz on March 4th and bombs started falling across the Middle East, did gold fall from 5-4? The answer is mechanical sequence. Write this down because you understand it. You will recognize it every time it appears, and you will never be caught off guard by it again. Step 1. A geopolitical event causes an oil shock. The Iran war drove Brent crude from 75 GFS to above $11-12 per barrel in 3 weeks. That is one of the largest energy supply disruptions in 50 years. Step 2. The oil spike drives inflation expectations higher. Not actual inflation immediately, but expectations. And expectations matter as much as reality to financial markets. When traders believe inflation is coming, they price it in immediately. Step 3. Inflation expectations prevent the Federal Reserve from cutting rates. The Fed had been signaling rate cuts as a possibility. The oil shock ended that conversation. Fed funds futures now show virtually no probability of before late 2026 at the earliest. Step 4. If the Fed cannot cut rates, bond yields stay elevated or move higher. The 10-year Treasury yield is currently at 4. That is the level at which a risk for U.S. government bond guaranteed by the full faith and credit of the United States pays you 4. 39% annually with no credit risk, no volatility, no storage costs, 0. Step 5. When bond yields are at 4.39%, the opportunity cost of holding gold, which pays nothing, rises significantly. Institutional capital does the math. Some of it rotates from gold into Treasury bonds. Step 6. Simultaneously, global investors seeking safety buy U.S. Treasuries. That demand for dollar-denominated assets strengthens the dollar. The dollar index rose above 100. A stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars. And when dollars are worth more, it takes fewer of them to buy an ounce. 3 headwinds hitting simultaneously. All 3 caused by the same oil shock that should, by every conventional understanding, be bullish for gold. This is why your gold is red while the world burns. And this is why it has always been red for a period during every major geopolitical oil shock in the last 50 years. But here's where the story changes completely, because this mechanical suppression does not last. I have watched it resolve the same way every single time, and I would like to show you the historical record, not as a promise because past performance is not a guarantee of anything, but because the pattern is so consistent and so structurally grounded that ignoring it would be the most expensive mistake you make. OPEC cuts production, slaps an embargo on the United States. Oil goes from $3 to $12, a 4-fold increase. Gold initially drops, and then gold rises 150% over the following 2 years. When you zoom out to the entire 1970-1980 period, the full arc of the oil inflation disaster that began with Nixon ending the gold standard, gold rose 2,300. Not a typo, 2,300%. The Iranian Revolution, the Shah falls, oil production collapses, oil prices go to levels that seemed unthinkable at the time. Gold does nothing immediately. Then over the following 12 months, gold rises 89%. Then in the year after that, another Kuwait. Oil spikes, gold pops roughly 10% in a few weeks. Energy stocks and defense stocks outperform everything. The post-9/11 world, markets crash, panic everywhere, and then gold begins a decade-long bull run from $250 per ounce, which was its price at the time, all the way to $1,000. That is a 660% move over 10 years. Russia invades Ukraine. Gold breaks through $2,000 for the first time. New all-time highs. Every major oil shock in the last 50 years followed by significant gold outperformance. Not because of luck, not because of coincidence, because the mechanism that temporarily suppresses gold during the shock. Higher yield, stronger dollar, forced institutional selling eventually reverses, and when it reverses, the structural case for gold reasserts itself with full force. Now here's what I need you to understand about 2026 specifically, because what makes this moment different from every previous cycle is not the war, it is the structural conditions the war landed on top of. In 1973, states' national debt was approximately $500 billion. Today, it is $39 trillion. That is not a larger version of the same thing. That is a fundamentally different fiscal reality. In 1973, central banks were selling gold. Today, central banks are expected to purchase approximately 755 tons of gold in 23 consecutive years of purchases above 1,000 tons, followed by a continued elevated buying. That is not diversification. That is strategic repositioning at a level the gold market has never seen. 1973, there was no silver supply deficit. The silver market is navigating a period where industrial consumption continues to outpace mine supply, resulting in a fifth consecutive year of market deficit, 5 consecutive years of demand exceeding supply, 5 years of inventory drawdown, 5 years of a structural imbalance that does not resolve itself because silver mine supply is largely a byproduct of other metals. You cannot simply decide to produce more silver in response to a price signal in 1970. Today, silver goes into every solar panel, every electric vehicle, every AI data center, every defense system, every semiconductor. The industrial demand base that silver's price rests on today is structurally larger, structurally more inelastic, and structurally less replaceable than anything that existed in any previous cycle. In 1973, the Federal Reserve had room rates at 20% under Paul Volcker to fight the inflation the oil shock created. That response, brutal as it was, broke the inflationary cycle. Today, the Federal Reserve is paying $1.3 trillion annually in interest on $39 trillion in debt. It cannot raise rates to 20. The arithmetic does not permit it, which means the oil shock from the Iran war is embedding into an inflationary environment that cannot be addressed through the same mechanism that resolved the 1970s version. Every structural condition is more extreme. Every structural driver is more powerful, and the mechanical suppression that is currently holding gold at 46 and 12, when JP Morgan's year-end target is $6,300, when Wells Fargo's target is $6,300, when UBS's target is $6,200 by September, is temporary. That gap between where gold is today and where the most sophisticated institutional forecasters say it is going is the unthinkable that I am talking about. Now, let me walk you through the 4-phase recovery pattern, because understanding which phase we are in right now changes everything about what you should do with that information. Phase 1, the panic phase. This is typically the first 1 to 4 weeks of a geopolitical shock. Oil spikes, gold spikes initially, then drops hard as the mechanical sequence I described takes hold. Financial media runs 24-hour coverage with dramatic music and red graphics designed to maximize your anxiety. Most retail investors do one of two things. They panic sell at the bottom of the initial drop, or they panic buy gold at the absolute top of the initial spike. Both are typically wrong. What are institutions doing in phase 1? Watching patiently. They have seen this movie before. They are not doing anything dramatic. They are positioning carefully while retail is either running for the exits or chasing the spike. Phase 2, the absorption phase, typically months 2 to 3, the initial panic subsides, the fear index, the VIX, comes down slightly, and gold pulls back from its initial spike, sometimes significantly. Silver falls more, 15 to add or more. This is where the largest number of individual investors make their most expensive decision. They look at their portfolio, they see red, They read a headline about gold being broken or failed as a safe haven, and they sell. In my 40 years of watching markets, I have seen this happen after every major crisis. And in every case, it was the worst possible time to sell. Not because I'm always right about what comes next, but because phase 2 is almost always the bottom. And selling at the bottom is how investors lock in losses rather than participating in recovery. Phase 3, the structural bid phase. Typically months 4 through 18, the broad market begins stabilizing. The panic-driven institutional selling that depressed gold in phases 1 and 2 exhausts itself. The structural buyers, central bankers who are buying regardless of the short-term price, institutional investors rebalancing into real assets, retail investors who are finally comfortable enough to re-enter begin accumulating. Gold finds a bid again, not the panic bid from phase 1, the structural bid backed by the forces I described. Central bank buying, supply deficits in silver, the debt dynamics that make monetary debasement eventual inevitability. Miners begin leveraging up on improving gold prices, energy infrastructure stocks rally as oil supply disruptions are priced into the medium-term outlook, and most retail investors are sitting on the sideline having sold in phase 2, too scared to re-enter, watching gold make new highs and telling themselves they will wait for the pullback. The pullback may never come. Phase 4, new all-time highs, typically month 12 onwards, sometimes extending 2 to 3 years. This is what the historical record shows. After every major oil shock, 1979 to 1980, new all-time highs. Post 9/11, all-time highs sustained for a decade. Post 2022, new all-time highs. The mechanism is always the same. The oil shock embeds inflation. The inflation forces the Fed to keep rates elevated for longer than the economy can comfortably sustain. Eventually, the debt arithmetic, the cost of servicing $39 trillion at 4 to 5%, overwhelms the inflation-fighting mandate. Rates come down, the dollar weakens. The 3 headwinds I described reverse simultaneously, and gold responds to all 3 tailwinds at once. I want to be honest about where I think we are right now. Based on the timeline of the Iran war and the price action I am observing, I believe we are somewhere in the transition between phase 2 and phase 3. The panic selling has occurred. The forced institutional liquidation for margin calls has largely exhausted itself. The structural buyers, central banks, long-term institutional allocators, physical gold buyers in Asia are beginning to accumulate at current levels. Ed Yardeni, while lowering his year-end 2026 forecast from $6,000 per ounce, is sticking with $10,000 by the end of the decade. That is not a bubble forecast. That is a debt cycle forecast. Now, I want to address something that I think is the most important insight I can give you about silver specifically, because silver's story in this cycle is different from gold, and it is different in a way that most investors do not fully understand. Gold led the initial phase of the trend, responding to sovereign and monetary drivers, while silver initially lagged before reacting with a delayed but higher velocity move. This dynamic, where silver often trails gold's initial breakout, but moves with greater intensity, creates a natural expansion-contraction in the ratio. In the 1979 cycle, silver did not just follow gold, it outperformed gold by a factor of 3 times. Gold rose approximately 276% from the Iranian Revolution to its 19. Silver rose from roughly $5 to $50, a tenfold increase. The reason silver is both a monetary metal and an industrial metal. In a crisis, the monetary properties drive the initial move, but as the crisis embeds into the economic system, properties add a second engine that gold does not have. In 2026, that second engine is more powerful than in any previous cycle. Solar panel installations worldwide require silver as a conductor, and that demand is not price sensitive at current levels because the cost of silver is a fraction of the total system cost. Electric vehicle production requires 60 to 80 Gs of silver per vehicle, compared to 15 to 20 G in a conventional car. AI data center cooling systems, defense electronics, satellite communications, all of them require silver, and none of them can readily substitute other materials without significant performance degradation. And then there is the supply constraint. The market is navigating a period where industrial consumption continues to outpace mine supply, resulting in a 5th consecutive year of market deficit. Supply elasticity remains low as most of the silver is mined as a byproduct, meaning production levels are often dictated by the economics of copper, lead, or zinc rather than silver market trends. 5 consecutive years of deficit, no supply response coming. An industrial demand base that is growing in applications where silver has no viable substitute. And China, which controls approximately 60% of global silver refining capacity, has restricted silver exports as a strategic material. When the monetary bid returns to silver, which the historical pattern says it will in Phase 3, the industrial demand that has been running continuously throughout the crisis period adds to it rather than subtracting from it. That combination is what produces silver's characteristic pattern of lagging gold on the way up and then overtaking it dramatically. Let me close with the two indicators I am personally watching to identify when the reversal from Phase 2 to Phase 3 is fully arrived. The first is the US dollar index, currently elevated above 99 due to the petrodollar demand surge created by the oil shock. When the DXY falls back below approximately 97, the primary mechanical headwind on gold prices diminishes. This will happen when oil stabilizes, when alternative supply routes through Saudi pipelines in the Maridi bypass infrastructure absorb enough of the Hormuz disruption to reduce the emergency dollar demand that the oil shock created. The second is the 10-year Treasury yield, currently at 4.39. When this falls back below 3.5%, the opportunity cost argument against holding gold weakens to the point where institutional rotation out of treasuries and back into gold becomes mechanically favorable. This will happen when the Federal Reserve begins cutting rates, which will happen when the debt arithmetic of $39 trillion at 4 to 5% makes it impossible to continue without causing a fiscal crisis is more severe than the inflation risk we're trying to prevent. These two indicators will tell you when the mechanical suppression is exhausting itself. The war news will not. The daily oil headlines will not. The financial media's 24-hour cycle will not. Watch the dollar. Watch the yield. Everything else is noise. Wells Fargo Investment Institute has lifted its year-end 2026 gold target to $600 an ounce, up from 4 JP Morgan forecasts $6,300 by year-end. UBS has increased its target to $6,200 by September 20. These are not retail investor wishes. These are the research departments of the institutions that manage more capital than any other entities on Earth. They are not issuing these targets because they believe the mechanical suppression currently operating is permanent. They are issuing them because they believe it is temporary and because they have done the structural analysis of central bank buying, supply deficits, debt dynamics, and rate trajectory that tells them the temporary suppression will eventually exhaust itself. There are two types of investors watching this unfold right now. The first type sees gold at $4,612, down from $595, and concludes the trade is over. They sold at the bottom of Phase 2, and 6 months from now, when gold is making new all-time highs, they will say, "I knew I should have held." The second type sees the same price and thinks Phase 2 absorption, mechanical suppression, structural setup, more bullish than at the top, and they accumulate quietly, patiently, while the noise is at its loudest. I have watched both types of investors across every major crisis of the last 40 years. I know which type builds wealth, and I know which type watches it happen from the sideline. The unthinkable is the move that is coming in gold and silver when Phase 3 begins in fall. Not unthinkable because it has never happened before. It has happened after every major oil shock in 50 years. Unthinkable because the structural conditions underlying it are more extreme than anything I have seen in 4 decades of watching these markets. More debt, more central bank buying, more silver deficit, more industrial demand, more fiscal constraint on the Federal Reserve. Watch the dollar, watch the yield, be patient, and do not let a Phase 2 sell-off make you miss the moves that every major institution on Earth has already calculated.